Guy over here, Ben, and we are Money Mondays. We do this every Monday, 3:30 Central. We talk about a bunch of different topics, fun stuff, boring stuff, and everything in between. But most of our stuff is fun stuff. We try to make it fun, right? Yeah, no. My parts are probably more fun than what Ben talks about, but that's just by nature. But today, what are we talking about, Ben?
So we're talking about underwriting multifamily deals as a passive investor, right? So we, at a lot of shows, we kind of talk about operators and syndicators and people that are putting the deals together, but we didn't want to neglect our friends that are just want to be passive investors, right? And there's a lot of them out there. They don't want to do what I want to do, which is be more active and lose my hair and have my blood pressure go up. They just want to put their money to work into great investment products, right? Yeah. And so, we're going to kind of, pull back the curtain a little bit and kind of say, these are the things that somebody should be looking for, right? Not necessarily red flags, but we're also LPs on a lot of people's deals. So you have to understand that at the end of the day, we're looking at it through both lenses, right? And what do we look at, knowing what we know as active investors, as far as things that I want to see in a deal offering, right? So we're going to get right into it right now. All right. So there's a couple things. Let's take a step back for those that don't know what you're to expect, right? You're going to have 4 documents that you typically have to review and then sign as part of being a passive investor, right? And I'm not going to go through all these because we've talked about them on the other show, right? PPM, there's a subscription agreement, there's an operating agreement, and there's typically an investor questionnaire, or there's some kind of accreditation verification that you have to go through to determine if you're an accredited investor, right?
I knew you knew something about real estate.
I don't know.
You got him right. You got him right.
So those are the 4 things. So you got to fill those out.
As a passive investor, right?
As a passive investor.
That's all we ask from our passive investors, right?
Yes. Hopefully they've reviewed the deal too, right? Yeah. Which is what we're going to talk about today. Some people don't. Right? They just kind of go like, hey, they like us, or they like the deal, or they like the area, and they just say, hey, I'm going to go ahead and invest in this, right? So, but those are typically the 4 legal documents that we have to have back from you that we will then in turn countersign, and then you wire in your money, and boom, really that's all you got to do, as a passive investor. So it's a pretty sweet hard deal, and you get some outweighed returns in return of that, right? So really what we wanted to kind of focus on today was when you're reviewing those documents or when you're reviewing the deck that a syndicator puts out there, what are some things that you should be on the lookout for, right? So one thing is how does the money, is it distributed, right? Is there a preferred return? Is there a waterfall, right? You need to understand you got $1 going in to the deal, and then how is that dollar distributed out amongst the different classes of shares, right? Or, does it all go to the passive investor? Is there a waterfall? Is there a preferred return, right? And preferred return, for people that don't know what I'm talking about, is typically a percentage of the amount that's raised, right? So let's just take real simplistic round numbers. If we raise $1 million and I'm giving people an 8% preferred return, I'm giving them $80,000 right off the top per year, right? And then anything above, say we make $100,000. So you got that $20,000 delta right there, right? Because the first 80 goes to the investors, right? We're then going to split that, right? Typically, from our perspective, it's anywhere from 70-30 to 75-25. Sometimes it's 80-20. So of that 20,000. So you can kind of get a feel for how the dollars are going to flow in and then out of the LLC. Right, and understanding that's probably one of the most important things, right? I think in a lot of ways people don't understand some of these structures are fairly complex, and then some of them are very, very easy, right? But I wouldn't say that the complex ones are bad. You just need to understand, and you're allowed as the passive investor to ask those questions. So don't feel shy about, hey, can you just walk me through how this works? And I think you're completely entitled to do that, right? Understanding return on your capital versus return of your capital. Right, there's 2 different things that are happening, right? Return on your capital, right, is you're making money on your money, right? Return of your capital is you're returning the money that you invested, right? And there's different times of different things that happen.
And read the PPM and the operating agreement carefully, right?
Yeah.
That's because they are kind of subtle terminologies, but it's really important to understand the difference. So what are you talking about, subtle?
Yeah.
I
was waiting for you to say something.
It was Ben subtle. Well, because I was talking and then I realized I missed the joke after the fact, so I was just gonna let it slide very subtly. But clearly you didn't let me do that.
That ship has sailed, bro. We got to keep moving forward.
But really quick, when we were talking about the previous one, right, about deep diving on the how the money is being distributed.
Yep.
And this one, all of that is in the PPM of the operating agreement.
Yes, it is.
Right. Yep. Typically, most sponsors will kind of show what that waterfall looks like, right? The kind of the key things. But again, what you sign is really the binding piece. So make sure you understand that.
And they'll typically say, okay, when you have a sale, right, it goes to paying off the closing costs and all the loans. Then it's return of people's capital, and then it's the preferred return and any catch up that you have there. Then there's a split. Any good SEC attorney should line that out within the PPM docs. But if you don't see that or don't understand that, once again, folks, raise your hand, ask the questions. I see too many people invest in these deals and they don't ask anything, right? Unless you really, really know the sponsor and really, really understand how these things can be structured, I get it. But for people that are just starting off, ask the questions. That's the most important thing, right? And so once again, return on your capital is you're making money on your money, right? Return of capital might be a refinance, right? So refinance, right? We raised $1 million and maybe we pulled out $500K at a refi. That $500K, at least the way that we structure it, other people structure it differently. Once again, read those documents. That $500,000 will be return of your capital, right? So you need to understand that, and what does that mean, right? Because now you've got $500,000, and then you're paying the 8% preferred return on the $500,000, no longer on the $1 million, right? So you need to understand that. I say the biggest thing that I look at, right, when it comes to financials and really the returns is reversion cap rate that they're going to use, the vacancy that they're underwriting to, and ultimately the rent escalators that they're using.
I think those are
three things that you need to understand.
Plus the rents, right? What rents are they trying to get?
Sure,
and do you
right.
agree with that, right? Ask for the market rents, understand what the other properties are. And honestly, as a passive investor, I'm not kidding you not, I would literally call some of the properties around there just to understand, do I buy into that vision, right? I think that's a huge part of it. It takes a couple seconds.
All right, so I know some of the people might be new that are tuning into our show. We've talked about these concepts in the past, but I'm going to go over them really quickly, right? Reversion cap rate is the cap rate that you think that you can sell the property at in the future, right? It's typically a real thumb in the air. There's not really a lot of math to it. The only real rule of thumb is that you should try to be conservative on it, right? So if you bought it at a 4.5 cap, you should underwrite it to selling it at a 5.5. It's typically anywhere from 10 to 20 basis points per year that you hold the deal, right? But what has happened in the last 5 years is that cap rates have actually gone down 10 or 20%, or maybe even more in some cases per year. So, that's the reversion cap rate. Vacancy, everybody kind of knows that, how many units are physically going to be occupied or not. There's also economic vacancy, right? So that's your loss to lease, that's your bad debt, that's your delinquency, that's your concessions, right? That's, you've got market rent, but maybe your market rent's $2,000, but you're only collecting $1,500 because you have a $500 a month concession. Guess what? That $500 is your economic vacancy, right? And then rent escalators. So if you've called the property and you believe that the comps that they're basing their underwriting on is true, right? Then they're going to start stepping into what is year two's rent's going to be. And some people, we've seen those pop 20%. And sometimes I've seen people pop rents 5 to 10% every year throughout the whole period.
Which is kind of nuts.
Which is insane, but people do it, and unless you're asking the questions, you're not going to know if people are being conservative or not, right? Typically, the rule of thumb outside of the last 6 months, where we've seen some tremendous rent growth, is anywhere from 2 to 4%, depending on the submarket and what you're going to be doing to the property, right? That's typically years 2 through whatever the whole period is, right? So that's the rent escalators. And how does that impact on the returns? They impact tremendously, right? If you're buying that 4.5 cap, deal, and then they say that they're going to sell it at a 3.5 cap, and then on top of that, they're going to say they only have 2% vacancy, and then on top of that, they're going to say they're popping rents 10% across the board every single year. Guess what? The most dog deal out there is going to look like
a lot of small
diamond in the
changes
rough.
can lead to a really big impact.
And yes, that's an extreme example, but these things compound on each other too, folks. So you need to ask those questions when you're looking over the deck, right? Or when somebody's presenting you with the deal. Those are probably the 3 things that can really move the needle one way or the other. How is the debt structured, right? Who's the lender? What's the interest rate? Is there preferred equity on the deal or not, right? And understanding where you sit in the capital stack, right? Typically for people, so just so they understand, you got senior debt, which is the lender. Then if you do have pref equity, your pref equity is right below that, right? It's called preferred equity for a reason, because it's higher in the capital stack. Therefore, it's more safe. And then below that is common equity, right? And you need to understand who gets paid when, who gets paid back first, and ultimately understanding the risks in the capital stack too.
Yeah.
Right? understanding your voting rights. Sometimes there's PPMs out there where you get really no voting rights.
Yeah, and exactly. Understand the cases where you as an investor need to help make a decision, right? Mm-hmm. If they want to sell the property, do you get a vote? Maybe not. If they want to buy another property, do you get that right or not, right? It talks about a lot of those nuances because, again, you're ultimately trying to find something that you're comfortable with, right? Both in terms of investment, in terms of returns, and in terms of operator. And some people love their operators and they trust the operator to make the best decision, right? Ultimately, you probably want to invest with something like that versus you don't trust your operator and you're having to look over their shoulder. That's probably not a good spot.
You're betting on the jockey, not the horse, folks, right? At the end of the day, the operator, when I'm looking at a deal to potentially, invest in, it's always the operator, then it's the submarket, then it's the deal, right? Because those two top things can really turn a bad deal good or a good deal bad. Right?
Question though, have you ever actually been a jockey on a horse?
Have I been a jockey on a horse? No, but I've ridden a horse.
You've ridden a horse?
I have ridden a horse. We rode horses a few weeks ago.
I know you have, but we got to go ride a horse on a race now. So
I don't know. I'm not really quite there, my friend. But all right, back to what we're talking about, which is passive investing.
But before we continue, Money Mondays do this every Monday, 3:30 Central. If you have comments, questions, thoughts, ideas, topics, whatever, please leave a comment. Let us know.
We want it to be interactive,
live.
right?
But if not, we'll keep continuing. So
let's move forward then. All right. Sounds like we don't have any questions. They're just absorbing all of this, and I love it. All right. So you need to understand those voting rights, right? Do you have to vote on a sale or a refinance, right? Can you replace the manager if you need to, right? What is that? And that should all once again be lined out in the PPM and the operating agreement, right? Skin in the game, right? Do they have it? And if so, how much? Right? So when I say skin in the game, that means how much are the active investors? How much are the GPs investing in the deal, right? Because remember, the GPs are the ones putting the deal together. And so are they putting any money in? Or if they are, how much? I think that's a valid question. In fact, one that we get on every single one of our deals. So instead of continuing to answer that question, we just put it straight up in the investor deck as to about how much we're going to invest, right? We just answer it in the FAQs. And then I think, and we touched on this a little bit, does it include a preferred return or not? There's deals that can be structured 1,000 different ways, folks, right? It's a transaction, it's a negotiation, right? What are your investors willing to take, and what are the active investors going out and putting deals together? What are they willing to provide, right? It's a transactional thing. And so we've seen everything from an 80-20 with no preferred return to a 50-50 with a preferred return, and anything in between. Right? Preferred return, once again, it's a percentage that you're making on the money that's invested in the deal. Right? We talked about an example of that earlier. So those are some things, major things that we look at when we're looking to invest into deals. What's important for us and what actually is going to move the needle in terms of questions. We get all kinds of crazy questions on our deals, and that's fine. We encourage people to ask questions, but we really feel like this stuff that we're going over today is really the meat of what's important for somebody to think about, right? And especially as you invest in the same operators over and over, you'll start realizing how they do it, how they structure it, what types of returns they're providing and how they're structuring
and
the
ultimately you get to the point where you trust them, but also you should always skim the PPM or ask them what's different, right? We've iterated, our model has changed over the years, right? We used to not do a pref, and now we do a pref, right? There's other things to think about. Not all deals are the same, and some structures are better suited than others, and so always understand what the nuances are, right? But again, like Ben said, you're betting on the jockey, not the horse.
Absolutely. So I'm going to pause there. Was there any questions that came in? We got to just make sure.
So we got one question that came in. Mr. Shane, do you have some rules of thumb for underwritten reserves or acquisition costs? Great question. Right, two things. Rules of thumb for reserves. Most deals, the lender is going to require that, right? But what you want to make sure as a passive investor, you want to look at the underwriting and make sure that the operator is actually, whatever he's presenting, returns to investors, that's net of reserves, right? Not that, hey, the lender's going to require this, we're going to get cash flow into that bucket, and now we can't give it to investors, right? You want to make sure, and the rule of thumb there is usually 200 to 350 on the high end, right, per unit per year.
Right? And that's the replacement reserves.
That's the replacement reserves.
Now, we also have other reserves too, right?
You want to
make sure that you're
I guess good point. So a couple other things, right? So you want to, we've done enough deals that ultimately, I think Ben and I are at the point where we like to have reserves, right?
Yeah.
We'd rather promise a little bit lower return and have a much safer investment for every investor, right? And so ultimately, reserves, if you were to peg a number, I mean, it's probably good to have, $2K a unit in reserves just sitting on the sideline, right? Somewhere in that range. You know what I mean? Just a rainy day fund, something blows up, something goes wrong. Maybe you have a transformer that messes up at a property. Ask us how we know. We're giggling because we had that happen today.
Literally today.
It's $50,000 to $70,000 expense out of the blue. That's where the rainy day fund is invaluable,
yes.
right?
Yeah.
And so it's good to have that, make sure that's modeled in. And then, I think the other piece of this, just acquisition costs, typically that's very lender specific and other things, but you're typically looking at 2% acquisition costs independent of operator fees and other things too.
Yeah,
but you're in that 2 to 3% probably all in.
You've got fees, right? And then you got closing costs, right? Closing costs typically on an acquisition is probably going to be, call it 2 to 3, right? And then there potentially could be, not everybody charges them an acquisition fee, right? And that's typically anywhere from 1 to 3. Once again, that should be outlined in your PPM. Any fees that anybody's going to take should be outlined. And you should see it in the investor deck as well, which is by just so everybody knows, the investor deck is always in the PPM as well. So maybe you've missed the webinar, you don't know where any of this stuff is. The investor deck is embedded within the PPM because they have to show what the actual business plan is as part of that.
Yeah.
So great question. I think that shows, is somebody being conservative or mitigating risk versus somebody that's really coming in, it's real tight, there's very little reserves, and if anything goes wrong, they might come back to you for a cash call. Another question another thing that you should be reviewing when you're a part of your PPM too is the cash call mandatory, or is it voluntary? And if so, what happens to my shares if I don't participate, right? And then for anybody that doesn't know what a cash call is, sometimes things happen. Transformers blow. Right? Luckily we have plenty of reserves on our deals, so it's not going to turn into a cash call situation. But somebody that doesn't, guess what? Either they're stroking that check as an active investor, or they're coming back to their investors to say, hey, we got to transfer that blue. I don't have the $50K to spot. Who wants to pony it up? And no better way to piss people off
All right.
than to start a week off on a cash call.
So let's keep going. So Shane also asked, do most sponsors you see provide the underwriting model or Excel sheet for review? I'll answer this one. By default, I think most don't. And the reason really is that it's usually too complicated for most investors to understand, right? An investor that does not understand the nuances will make, bad assumptions and probably misunderstand it. That said, any sponsor that is transparent and candid, they'll share it out.
Yeah, it's not that
right.
big.
Someone asks for it, we'll share it. Here's it is. Let's go talk through it, right?
Yeah.
Typically, you want to get on a call and try to walk through it with somebody, right? But that's definitely, I think,
yeah, because everybody's got
different.
different sheets. I think you bring up a good point, right? Our sheet is heavily customized, and it might be completely different from the next guy or gal's sheet too. Yeah. So you have to understand how the numbers flow, right? And so, but yeah, if anybody ever asks, we typically will provide that. That's not a problem, but it's not something that you just broadly give to everybody, mainly because at the end of the day, the sheet's copyrighted, and not ours to give around.
Let's keep going. So a person on LinkedIn says, what is a typical asset management fee for value add deals? I'll say, asset management, the industry norm is 1.5% to 2.5%. That's what you typically see on asset management. Now that said, the value add piece is typically handled as a different fee, right? A lot of times you see a construction management fee, which is, hey, we're doing $2 million of construction, and the operator will take 8% of that, right? Anywhere from 3%ish, I think is kind of
I've seen upwards to 10.
3 to 10. I mean, it just kind of depends on a lot of things. And so that's typically how that value add component does. But whether it's a brand new asset or a 50-year-old asset or a 100-year-old asset, the asset management fee is really more so covering, supervising the property management company, dealing with the CPA and getting K1s and just kind of making sure the business plan gets executed. The fee for the actual value add piece is a different.
You oversimplified the heck out of that thing, man.
Yeah, asset management is the easiest part of the business. Let's keep going. Rasul
It's not that
asks, how would an investor know if a syndicator is being realistic with their projections or being overly optimistic with their promise in the pitch deck? Is there any recourse for gross overstatements?
No, there's no recourse. Obviously, buyer beware, right? I mean, it's pretty much lined out in the PPM, all the risks.
Look for people with track records. And track record doesn't mean just buy. Buy is easy. Buying deals is easy. Look for people that have done full cycle deals. Where do they actually return on their investors? Both what do they distribute and what do they actually do on the sale? So.
No, I agree. But I mean, once again, buyer beware. It lists all the PPM, has all the risks in there. And ultimately, at the end of the day, folks, what we do has an inherent amount of risk, and you could lose your whole entire investment, right? But that's why it's called LP. You're limited to the investment that you have into it. So, but at the end of the day, right, you have to really verify. Trust, but verify. And I think, people that have maybe a little bit more robust of a track record, resume, ultimately ask people in the industry too, right? What do you think about these guys? Are they legit? Are they good guys or good gals? And, or have what they said, come to fruition? Because I think at the end of the day, like Ferris had mentioned, you can buy all day long, but that's just acquisition. So you might be a great acquirer of real estate, but if nothing ever pays out or you don't exit anything for any meaningful return, then it's all just, fluff in the end, right? And we see a lot of that out there in the market.
So let's see if you have any more comments, questions, thoughts, ideas. Please go ahead and leave them. We'll answer them live. We got another one. Garen, I apologize for butchering the name, but it says, how would you suggest a passive investor verify the track record of their sponsors, deals, returns, etc.? Ask for it, right?
Yeah,
ultimately, you could do research, see if they've done those deals, right? And understand, what was their participation in that, right? A lot of these deals these days have a lot of people involved. We'll leave it at that. Yeah. But understand what they did, right? And, ultimately, were those returns what they expected? And you could ask for an investor referral, right?
Yeah.
That's the thing that a lot of people do. We're at the point where we've just grown enough that our track record speaks for itself, right? But again, we'll give the occasional referral where it makes sense, right? And so you don't want to be too, as a passive investor, you don't want to be too onerous, right? But again, ultimately, you need to invest in people you trust.
Yeah.
Right? If you don't trust them to give you an accurate track record, that's its own problem. So
we literally have it on our investor deck, right? We just kind of go through our whole track record, which makes it easy because people then don't have to go and, look it up. But, anything beyond that, we're always happy to provide returns and what had happened, right? But I think Ferris had mentioned, right, there's a point where, people can be asking questions and doing due diligence, as part of the raise. And then by the time they finally get comfortable with the deal, the thing's already filled up or that train has left the station. So you have to be careful. You have to balance those things. And I think that's why doing due diligence up front and then being ready for that person or that group's deal when they ultimately put it out there is important. So get ahead of it even as a passive investor. I always tell people, you're not going to find a bunch of operators and deals and people that you can put money into unless you're out there networking. Even if it's a webinar, right? You got to get out there and you got to understand who's all doing deals out there. Don't just rely on one or two groups because then you might not be diversifying enough. So, boom.
Let's see.
We got through it.
Let's keep going then. No other comments, questions? We can keep going.
Oh my gosh. The Multifamily Investor Network Conference.
Do you have our big conference for anybody? That's anybody in multifamily. You got to be there. It's basically coming up February 12th. It's our biggest conference back here in our backyard in Houston. It's a good time to be in Houston first and foremost, and we have an awesome lineup.
Be hot.
No, it's a good time to visit. We try to make this a good place to visit every year. Stay tuned for what we're going to do in the summer, right? But ultimately, awesome lineup. One of our best lineups, I'd say, to date, right? Really big variety, and we're excited. So tickets are going fast, and we are expecting a huge turnout, 400 or 500 people at this one. So we look forward to seeing it there.
What's that discount code,
Use
buddy?
the code DISRUPT for $100 off. You could try that code on anything. If you're buying a house, you could ask them, hey, do you take a discount code DISRUPT? Or if you're at the grocery store, try it out. Usually, maybe you could find other benefits
I
of it.
wouldn't bank on that coupon code working anywhere else,
mfinvestornetwork.com, $100 off, coupon code DISRUPT. So we look forward to seeing you guys there before it sells out.
Yep. And then we've got MFMCon coming up, and I think
where are we going this weekend, Ben?
Those tickets might have been sold up. Oh, last call.
Last call. So we will be in Orlando this weekend. We are flying out there Friday and coming back Sunday because we'll be participating in MFCon. It's a conference that we help host. $100 off. It should be pretty fun. It's the first MFCon ever and getting a lot of interest. So we'll kind of look forward to seeing you guys there if you want to come hang out with us. bring a deal. Ben will underwrite it for you, and
Possibly.
we'll go from there.
It just depends on how good it is, right? So last call.
We should
right?
have a booth.
Multifamily
I'll underwrite
con.
your deal booth at one of our conferences and just have
Multifamilycon.com. Stay on target here, man.
Always
Coupon
on
called
target.
Last Call, right? $100 off. This is all affiliated with Multifamily Masters, which is a group that we're proud to be a part of. Has a bunch of networking groups throughout the country. This is our big conference that's coming together, and so we're excited to be in Orlando this weekend. If you're in Florida, stop in.
Forward to
Say
seeing
hi.
you there.
Anybody else wants to get a last minute ticket, we'd love to see you then too. All right.
Otherwise, that's it, right?
What's coming up next week?
Red flags and multifamily real estate
Oh
offerings.
my God.
So it's gonna be a busy Monday because we're gonna be coming back from Orlando. It's
when do
gonna be
we
a
get
lot
back?
going
We
on.
get back in like-
We're back Sunday night.
Yeah, okay. All right.
But
so-
we'll see you guys next Monday. Monday Mondays is every Monday, 3:30 Central.